Right now, somewhere out there, you are checking the Bitcoin price for maybe the third time today. I know because I do it too. And right now, Bitcoin is sitting in that frustrating low $60,000 range, refusing to do anything dramatic, refusing to give you a clean answer, refusing to make you feel like a genius or an idiot. It is just sitting there, boring, sideways, almost insulting in how uneventful it feels after everything you were promised about this cycle. But while you were watching that number, something else was happening, something almost nobody was paying attention to. BlackRock, Wall Street, tokenized stocks, stablecoins, and one number that should stop you in your tracks, $4 trillion. Before we go further, a quick disclaimer, because this matters. Nothing in this video is financial advice. I'm not your advisor. I do not know your situation. And every number you're about to hear is a projection, a scenario, or a piece of commentary from industry voices, not a guarantee of anything. Markets can go down as easily as they go up. Do your own research, and if you need personalized guidance, talk to a licensed professional. Now let's get into it. Bitwise. Chief Investment Officer Matt Hougan has spent the last several weeks saying something that most crypto investors are simply not hearing because they're too busy staring at candles. He's not talking about whether Bitcoin bounces off support this week. He's talking about the financial system itself quietly being rebuilt, one settlement rail at a time. And what he's describing might be a lot bigger than another Bitcoin rally. Here's the setup. While investors argue over whether Bitcoin revisits recent lows or finally breaks out, Wall Street has begun experimenting with something much larger, putting real financial assets on blockchain rails. Stocks, funds, treasuries, stablecoins, settlement itself. Analysts at Standard Chartered have projected that the value of tokenized real-world assets could climb toward roughly $4 trillion by the end of the year, 2028. Separately, Citi has floated similar territory for the stablecoin market alone by the year 2030. Different firms, different methodologies, but the same underlying signal. Something is scaling, and it is scaling fast. Now here's where it gets interesting, and I promise you, stay with me, because the next part is the part almost nobody in crypto media is actually talking about. That $4 trillion figure might not even be the biggest number in this story. Hougan has also pointed to something much larger sitting quietly in the background. Institutional capital pools, controlling somewhere in the range of $100 trillion to $200 trillion. Pension funds, sovereign wealth funds, insurance companies, endowments, the kind of money that doesn't chase headlines, doesn't panic sell on a red candle, and doesn't care what's trending on your favorite crypto account this week. And if even a sliver of that, say 1%, eventually finds its way toward Bitcoin, you're talking about $1 trillion to $2 trillion of potential capital. Not tomorrow, not guaranteed, but over years, maybe a decade, as digital assets slowly become just another normal line item on an institutional balance sheet. So here's the real question, hiding underneath all of this, and I want you to actually sit with it for a second instead of scrolling past. What happens when Wall Street stops treating crypto like some speculative side bet and starts treating blockchain like actual financial infrastructure? There is one development that could tell us whether this transformation is still just a theory on a slide deck, or whether it has already quietly started. I'm not going to give it away yet. We're building to it, and trust me, it's worth the wait. Before we go further, quick question for you, genuinely curious. What are you doing while watching this right now? Are you at your desk pretending to work? Are you lying in bed scrolling before sleep? Or are you actually watching Bitcoin charts on a second screen right now? Drop it in the comments below, I actually read them. Let's talk about the weird contradiction sitting right in front of us, because once you see it, you cannot unsee it. Bitcoin, on the surface, looks tired. It's been trading well below its record highs. Sentiment has swung bearish according to several technical trackers, and retail interest has cooled off compared to the mania phases of past cycles. Regulatory uncertainty in Washington hasn't fully cleared either, which we'll get into shortly. This is not the explosive, headline-grabbing bull run some people were promised at the start of this year. But underneath that surface, something completely different is happening. Hougan has said publicly that his conversations with financial advisors have shifted noticeably. Advisors are talking less about Bitcoin as a speculative trade and more about stablecoins and tokenization as practical, almost boring financial infrastructure. Boring in this context is actually a compliment. Boring is what institutions want. Boring is what gets approved by compliance departments. So here's the contradiction stated plainly. Bitcoin can look sleepy and uninspired on a price chart while the infrastructure underneath the entire crypto industry becomes more important than it has ever been. If that sounds strange, stay with me, because this is exactly where that $4 trillion figure starts making a lot more sense. I need to correct something right away, because this is where a lot of crypto content gets sloppy and misleading. $4 trillion is not a Bitcoin price target. It is not code for Bitcoin's market cap goes to $4 trillion. It refers to the projected value of tokenized real-world assets, meaning stocks, bonds, funds, real estate, and other traditional instruments represented and traded on blockchain rails. Right now, industry estimates put the total value of assets actually on-chain somewhere around $300 billion. Compare that to the traditional financial system, which holds hundreds of trillions of dollars in assets globally. 300 billion against hundreds of trillions. That gap, that enormous, almost embarrassing gap, is the opportunity Hougan keeps pointing back to. Think about that for a second. We're not talking about a market that's already mature and just needs a little more growth. We're talking about a market that represents a fraction of a percent of what it could eventually become if even a modest slice of traditional finance migrates on-chain. So why would Wall Street, an industry built on decades of legacy infrastructure, comfortable margins, and cautious compliance departments, voluntarily move any of its assets onto something as unfamiliar as blockchain rails? That's the part most crypto investors completely misunderstand. And it's the part we need to talk about next, because the answer isn't ideology. It isn't belief. It's something far more predictable than that. Here's a sentence I want you to actually remember after this video ends. Wall Street does not need to have any ideological conviction about crypto whatsoever. It only needs a reason to make more money, more efficiently, with less friction. That's it. That's the entire catalyst. Traditional markets operate within real constraints. They close at certain hours. Settlement can take days rather than seconds. Multiple intermediaries sit between a buyer and a seller, each one taking a small cut, each one adding a small delay. Cross-border transactions face currency friction and jurisdictional headaches. Tokenized markets, at least in theory, offer something meaningfully different. Trading that can happen continuously, 24 hours a day, 7 days a week. Settlement that can potentially happen in minutes instead of days. Assets that can be fractionalized, so a smaller investor can own a sliver of something previously reserved for institutions. Programmable compliance built directly into the asset itself. More efficient movement of collateral between institutions. None of that requires anyone at a major asset manager to believe Bitcoin is going to replace the dollar. It only requires someone in a boardroom to ask a simple, unglamorous question. Can we make more money, more efficiently, if we build this on blockchain rails instead of our current legacy systems? Picture two financial systems side by side. In the first, markets close every evening, settlement drags out over days, and multiple middlemen sit between every transaction. In the second, assets move continuously, settlement happens dramatically faster, and financial products can be programmed to behave in ways static paper contracts never could. Now ask yourself honestly, which system would a firm managing trillions of dollars eventually prefer once the technology and the regulation catch up to each other? That's not a rhetorical trick question. I actually want you to think about your answer, because it tells you something about how you're framing this entire trend in your head. And now we arrive at the institution that could make this whole shift accelerate faster than most crypto investors currently expect. I need to be careful here, because it's easy to turn this into a lazy headline. BlackRock is buying Bitcoin, so Bitcoin goes to the moon. That is not the argument, and honestly, that framing insults how much more interesting the real story actually is. The real argument is this. BlackRock, the largest asset manager on the planet, has been quietly building infrastructure for a tokenized financial world, not just accumulating Bitcoin exposure through its exchange-traded funds. Hougan's argument is essentially about competitive psychology. Once a firm the size of BlackRock starts moving seriously toward tokenization, every single competitor is forced to ask an uncomfortable question in their next board meeting. Why aren't we doing this too? Here's how that pressure tends to spread through an industry. One giant moves first. Competitors notice immediately because in finance, nobody wants to be caught flat-footed. Boards start asking pointed questions at quarterly meetings. Other asset managers begin quiet internal experiments. Exchanges start investing in the infrastructure needed to support tokenized products. Custodians adapt their systems to hold these new asset types safely. Regulators, seeing real institutional money involved, start taking the conversation more seriously. Clients, especially younger and more digitally native ones, start demanding access. And slowly, a network effect builds that's very hard to reverse once it gains momentum. Here's what they're not telling you in most of the mainstream coverage. The biggest catalyst for adoption might not be excitement, might not be fear of missing out on gains. It might simply be fear of being left behind by competitors who moved first. That's a much less exciting headline than Bitcoin to the moon, I know, but it might be a far more reliable one. There's a problem sitting in the middle of all of this, though, and it's one that's been dominating actual crypto policy conversations throughout this entire summer. Washington still has not fully resolved the regulatory question. And that brings us to the Clarity Act. This part is genuinely frustrating if you've been following it closely, so let me walk you through where things actually stand as of the middle of August in the year 2026. The market had circled early August as a potential turning point. The House of Representatives had already passed its version of the Digital Asset Market Clarity Act more than a year earlier, with a striking, genuinely bipartisan vote. The Senate Banking Committee advanced its own version in mid-May by a solid margin. By early June, the bill was formally placed on the Senate's legislative calendar, eligible for a full floor vote. Then came the actual deadline. Senate leadership indicated a floor vote could happen before the traditional August recess. Cloture was filed, hopes rose, and then, right at the edge of the deadline, the Senate recessed on the 8th of August without a final vote, pushing the next real procedural step to the middle of September. So no, the Clarity Act has not passed yet. It's not dead either. It's sitting in a strange limbo, waiting on unresolved disagreements over ethics provisions, oversight of decentralized finance, and how illicit finance protections should be written into the final text. Here's Hougan's interpretation of that mess, and it's worth sitting with for a second. Crypto doesn't necessarily stop just because Congress moves at Congress speed. The old assumption in this industry used to be simple. Crypto needs Washington's blessing before real institutional adoption can happen. The newer, more interesting possibility is that institutions may keep building anyway, with or without a finished bill, while regulators like the SEC continue advancing rulemaking on their own timeline in parallel. Regulation, in this framing, may determine how fast adoption happens, but it may no longer determine whether adoption happens at all. Stay with me here, because that distinction is genuinely enormous once you actually think it through. It means the absence of a bill isn't necessarily the absence of progress. It just means progress is happening more quietly, without a ribbon-cutting ceremony in Washington. If institutions can keep building infrastructure without waiting for a vote in the Senate, then the next real phase of adoption could unfold almost in spite of the political calendar, not because of it. Quick question for you, and I mean this genuinely. Do you think Washington actually helps or hurts crypto adoption at this point? Comment below with your honest take. I want to see where people actually land on this. The Uber moment for finance. Hougan has used a comparison that I think is genuinely useful here, even if it's become a bit of a cliche in tech circles. The early days of Uber, Airbnb, and the internet itself. In each case, the pattern looked remarkably similar. New technology creates real, tangible demand before regulation is ready for it. Users start adopting it anyway, often faster than lawmakers can react. Businesses follow the users because that's where the money and attention are going. And eventually, regulators adapt, sometimes years after the fact, to a reality that's already been established on the ground. Regulation can absolutely slow adoption down. What it cannot do, historically, is erase genuine economic demand once that demand exists. This is where the story stops being purely about crypto and starts being about how financial systems evolve in general, not through one dramatic, cinematic switch flipped overnight, through incentives, accumulating quietly, one institution at a time. And once you frame it that way, stocks don't need to become crypto in some ideological sense. They can simply become tokenized financial assets. Bonds can become tokenized. Funds can become tokenized. Treasuries can become tokenized. Collateral can move more efficiently between institutions. Payments can increasingly settle on blockchain-based rails. And once you understand that shift, Bitcoin's actual role in this story becomes a lot more interesting than most headlines give it credit for. Bitcoin is not the entire story. This part matters because I don't want this video to turn into another tokenization sales pitch that forgets what actually brought most of you here in the first place. Bitcoin does not need to tokenize the entire global economy. It doesn't need to process every stock trade or replace every bank on the planet. That was never really the thesis, no matter how many old YouTube thumbnails told you otherwise. The more measured argument is this. Bitcoin could increasingly function as a form of digital monetary collateral, digital gold for a more digitized era, a portfolio asset. Institutions hold specifically because it behaves differently from stocks and bonds, a globally liquid reserve asset that doesn't depend on any single government's decisions. Meanwhile, other blockchain networks, Ethereum, Solana, and others Hougan has mentioned favorably in recent commentary, could end up handling the heavier lifting of tokenized securities, stablecoin infrastructure, decentralized applications, and day-to-day settlement. Here's a line worth sitting with. Bitcoin may not need to own the entire blockchain economy to benefit enormously from it. It may only need to remain the dominant monetary asset sitting inside that economy. That's a meaningfully different and honestly more realistic thesis than Bitcoin becomes the new global settlement layer for everything. And it's exactly where Hougan's newest capital allocation argument becomes genuinely fascinating. Here's where we come back to that number I promised you earlier. Stay with me, because this is the part of the video I think you'll actually remember tomorrow. Hougan has pointed to institutional capital pools, spanning pensions, sovereign wealth funds, insurers, and large asset managers that collectively control somewhere in the neighborhood of $100 trillion to $200 trillion globally. Now let's run the simple math, because the simplicity is exactly what makes it powerful. 1% of $100 trillion is $1 trillion. 1% of $200 trillion is $2 trillion. I want to be completely clear, because credibility matters more to me than hype. This is not a prediction that this money is coming. It's not a guarantee, it's not a timeline, and anyone telling you it's a sure thing is selling you something. This is a scale demonstration, nothing more, nothing less. But here's the part that tends to get underestimated. Bitcoin doesn't need every single institution on Earth to become a devoted believer. It doesn't even need most institutions to make a large allocation. It simply needs to become normal enough to justify a small, unremarkable slice of a diversified portfolio. 1%, maybe 2, maybe 3 for the more aggressive allocators. Picture the number $100 trillion to $200 trillion. Now picture just 1% of it. 1% sounds almost insultingly small when you first hear it, doesn't it? But when the denominator underneath that percentage is measured in the hundreds of trillions, tiny stops being tiny. Tiny becomes enormous. Here's what they're not telling you in most retail-focused coverage of this topic. This entire conversation isn't really about whether Bitcoin pumps next month. It's about whether Bitcoin becomes boring enough, stable enough, and normal enough to earn a permanent, unglamorous seat at the institutional table. Hougan's conversations with large wealth management platforms have apparently revealed something that retail investors, myself included on my worst days, tend to forget entirely. These institutions are thinking in years, not in weeks. Retail investors, understandably, tend to ask a very specific kind of question. Is Bitcoin going to 60,000? Is it going lower? Is it finally going to break past its old highs this quarter? Institutions, by contrast, tend to ask a completely different kind of question. How should digital assets realistically fit into a diversified portfolio over the next 5 to 10 years? The behavioral gap here is honestly kind of remarkable once you notice it. Retail tends to move through a pattern of price, then emotion, then decision, often in that exact order, which is rarely a great order for making good decisions. Institutions tend to move through a pattern of allocation, then infrastructure, then a long time horizon, which tends to smooth out exactly the kind of emotional whiplash that wrecks retail portfolios during volatile stretches. Retail watches candles. Institutions watch capital flows. Retail asks where Bitcoin goes next month. Institutions ask what financial markets might realistically look like by the year 2030. Which mindset do you think actually wins over a full decade? I'm not going to answer that one for you. I want you to actually sit with it. Let's talk about market behavior for a second, because there's something subtle happening that deserves real attention. According to Hougan's recent commentary, one of the more interesting signals in this current bear phase isn't a specific price level at all. It's what happens, or rather what doesn't happen, when bad news hits the market. There's been real volatility this year, selling pressure, regulatory disappointment around the stalled Clarity Act, broader macro weakness weighing on risk assets generally. And yet, according to several indicators Hougan has cited, retail selling pressure has noticeably declined compared to earlier cycles, even as institutional holders have continued maintaining their exposure through exchange-traded funds and regulated vehicles. This does not prove that a bottom is officially in. Nobody, including Hougan himself, has claimed that with any real confidence. What it might suggest instead is something quieter and arguably more important. The marginal seller may genuinely be running out of things to sell. Investors who wanted out may have already gotten out in earlier, more painful rounds of this cycle. Long-term holders, especially institutional ones, tend not to react dramatically to every individual piece of bad news. And as more of the market shifts toward multi-year time horizons rather than next-week trading decisions, price action naturally starts to compress. But here's the dangerous part, and I don't want to gloss over it just because it complicates a tidy narrative. If volatility has genuinely been compressed rather than eliminated entirely, whatever eventually releases that pressure could move fast, and it could move in either direction. Let's be completely honest with each other for a moment, because I think too much crypto content refuses to admit real uncertainty. Bitcoin could fall further from here. It could remain frustratingly sideways for months. It could suddenly break higher without much warning at all. Nobody, not Hougan, not me, not whichever confident voice you follow on social media, actually knows which of those three outcomes comes next, or exactly when. That uncertainty is precisely why Hougan has repeatedly emphasized a dollar-cost averaging approach, rather than trying to perfectly time an entry. And I think that's worth genuinely understanding rather than just nodding along to. Dollar-cost averaging isn't really about predicting the exact bottom. It's about reducing the behavioral risk that comes from trying to be a hero with your timing. Here's a simple way to picture it. You put in a portion of your intended position. Bitcoin falls further. You add another portion at the lower price. Bitcoin eventually rises. You already have meaningful exposure in place rather than sitting on the sidelines waiting for a perfect moment that may never clearly announce itself. The perfect entry point is psychologically very attractive to imagine. It feels achievable in hindsight, looking back at old charts. But in real time, as it's actually happening, the perfect entry almost never announces itself clearly enough for anyone to confidently act on it. Let's go back to where we started, because now, finally, all of these pieces click into place. That $4 trillion figure was never really the whole story. It was only the first visible layer of something much bigger. Layer 1, tokenized real-world assets, potentially approaching $4 trillion in value by the end of the year 2028, according to Standard Chartered's projections. Layer 2, institutional capital pools, sitting somewhere between $100 trillion and $200 trillion globally, mostly untouched by digital assets so far. Layer 3, even a modest 1% shift of that capital pool representing somewhere between $1 trillion and $2 trillion of potential movement over time. Layer 4, financial markets that increasingly operate continuously, 24 hours a day, rather than shutting down every evening. Layer 5, Bitcoin gradually becoming normalized as a legitimate, if still relatively small, strategic portfolio asset, rather than a speculative curiosity. So the shockwave that this video's title promised isn't really one dramatic, headline-grabbing $4 trillion Bitcoin purchase happening overnight. It's something slower, quieter, and honestly harder to sensationalize. The gradual, uneven convergence of traditional finance and blockchain infrastructure, happening whether or not it makes for a great headline on any given Tuesday. Maybe Bitcoin's next 10% move isn't actually the most important thing happening in crypto right now, even though it feels that way every single time you refresh the price. Maybe the bigger story, the one that actually matters over a 5 or 10-year horizon, is that Wall Street is quietly rebuilding meaningful pieces of the financial system around digital rails, one unglamorous infrastructure decision at a time. Stocks are inching toward tokenization. Stablecoins are becoming genuine financial infrastructure rather than just a crypto trade, a tool. Institutions are slowly reconsidering how digital assets fit into long-term portfolios. And blockchain, whether the mainstream financial press wants to admit it yet or not, is moving from experiment towards something closer to actual infrastructure. So here's my honest question for you, and I'd genuinely like an answer in the comments. If trillions of dollars in traditional financial assets eventually move on-chain over the coming years, does it really make sense to build your entire crypto thesis around whether Bitcoin falls another 10% this particular month? Because the next real crypto cycle may not be primarily driven by retail speculation the way past cycles were. It may be driven by slow, methodical institutional adoption instead. And the most powerful signal in this entire story might not even be Bitcoin's price on any given day. It might be the growing amount of traditional finance quietly moving onto the same digital rails, one institution, one asset manager, one boardroom conversation at a time. Before you go, one more genuinely random question, because I like knowing who's actually watching this all the way through. How's the weather where you are right now? I'm curious whether this video is reaching more people in the middle of a heat wave or already bracing for autumn. Let me know below. If this kind of breakdown actually helped you see the bigger picture instead of just chasing the next candle, that's exactly what this channel exists for. Comment below if you think institutional adoption matters more than short-term price action right now. Hit like if you made it this far without skipping ahead. Subscribe if you want more of this kind of macro capital flow thinking instead of another generic price prediction video. And share this with someone in your life who's still convinced this entire industry is just about gambling on candles. This is the wealth continuum. We don't just chase the price, we follow the capital, we follow the institutions, and most importantly, we try to spot where the financial system is actually heading before the rest of the crowd realizes it's already moving. Because the biggest wealth shifts almost never begin with a dramatic headline. They begin quietly, with a change in infrastructure that most people don't notice until it's already reshaped everything around them.